Okay, the bell is rung. S&P 500 closes out the Friday session at 6,958. That's a headline gain of plus 0.20% for the day. So that's the scoreboard. But when you look a little closer, that number is, well, it's pretty deceptive. For the entire week, the SPX only managed a barely positive 0.1% gain. The Nasdaq Comp finished the week a little better, up 0.2%. But the Dow actually slipped, losing 0.1% over the last 5 sessions.
And that 0.20% gain on the S&P today is, it's the definition of a head fake. We saw a significant intraday erosion after that morning burst of energy. The market hit fresh record highs, only to pare those gains back and sharply right into the closing print. What you're looking at is a market that failed to hold its momentum, and that suggests a major liquidity event took place this afternoon.
I agree completely. That afternoon fade was aggressive. It turned what should have been a blowout Friday, riding all that massive tech momentum, into just a choppy mess. So let's unpack this mess. What were the two big conflicting forces driving this thing?
It was a classic, high-stakes battle between what I'd call performance and policy. On the performance side, the fuel was just pure, undeniable tech euphoria. We had this huge tailwind from record-breaking semiconductor guidance, from players like Taiwan Semi, TSM. TSM jumped 4.4%, and Micron, MU, was also flying.
And the US-Taiwan trade agreement on top of that.
Exactly. That just eased all that supply chain anxiety. So that's the engine. That's what was powering us higher this weekend.
Right, the whole AI CapEx momentum story. The idea that the money flow into GPUs and specialized chips is only accelerating. That was supposed to carry us straight through the 7,000 magnet without even stopping.
It was. But the policy friction, it just proved too strong to overcome. This building political risk kept the broader indices pinned and, ultimately led to that afternoon sell-off. We saw two major catalysts hit the tape midday. First, you had the headlines about the Department of Justice subpoena for Fed Chair Powell. That immediately cast doubt on Fed independence, put a political cloud over rates. And then second, President Trump's midday comments. He was cooling significantly on Kevin Hassett for the Fed chair role.
Okay, so that Fed chair shuffle uncertainty, it just hit the rates market instantly. For the trader listening, what's the critical so what of that political shock hitting the Fed? Why does the market care so much right now about who sits in that chair?
Because it just destroys any certainty about the forward curve. The market was swinging wildly between the possibility of, say, a hawkish Kevin Warsh getting the nod, which implies higher rates for longer, versus a more dovish Hassett. And that uncertainty is poison when you're carrying long equity exposure into
a 3-day weekend, of course.
Precisely. It immediately spiked the benchmark 10-year yield up to 4.22%.
And when the 10-year spikes that hard and that fast, especially on a thin Friday tape, it fundamentally challenges the valuation models holding up tech and growth.
It does. That rate surge didn't just tick up. It forced a massive, a non-discretionary liquidity exit ahead of the long weekend. Traders who rely on defined risk parameters, they had to square their books, they had to dump exposure, especially from those longer duration growth names, and that drove the sharp decline we saw into the bell.
That pressure cooker effect.
Yeah.
That makes perfect sense for the afternoon fade. And we saw that friction play out so clearly in the sector rotation today. It confirms that thesis of a two-speed market. Technology was the undisputed leader, just surfing that CapEx wave.
Right. But the laggard was financials. They took a direct hit. And it's not just that financials are sensitive to the rising 10-year. The sector is aggressively pricing in the risk from these potential new federal caps on credit card interest rates. That risk is hitting bank valuations hard, particularly in the regionals, which suggests the bank rally is hitting a valuation wall much faster than people expected.
What's also fascinating here is the continuation of a core trend we've been watching. This rotation out of mega-cap growth and into value. Small caps, the Russell 2000, have now outperformed the S&P 500 for 11 straight sessions? That is some serious conviction.
That is the single clearest trend confirmation we have right now. The rotation is real. And the narrative that the Magnificent Seven trade is funding the small cap value rotation. Well, it's playing out in real time. We are seeing capital migrate from the highest flyers to the catch-up plays. The market is telling you it wants exposure, but it's getting very selective about price.
Okay, that brings us to the internals. This is where we find out if real money, the big institutions, were buying this close, or if that afternoon tape was just retail momentum that got used as an exit ramp. What does the volume confirmation tell us about conviction?
The verdict is crystal clear. This was a low conviction move to end the week. Volume trended, 8 to 12% below the 30-day average for the entire session. We were on holiday tape thinness today. And that means moves get amplified and the price action is just less trustworthy.
So the smart money wasn't adding exposure heading into a 3-day weekend with all this political risk. They were just squaring books,
Yeah,
managing risk.
precisely. And if we look at the institutional action, the narrative gets a lot darker than just low conviction. They absolutely faded the rally. The morning, markets hit session highs, driven by Micron, big tech, the whole momentum trade riding on TSM's coattails. But the moment those Fed chair headlines hit, the institutional distribution signal flashed bright red.
Let's define that for the listener. Finishing near the flat line after being up so much in the morning, especially on lower volume. Why is that a distribution signal and not just, profit-taking?
Because it implies coordinated selling. They use that morning retail AI hype, that initial momentum, as a perfect high-volume exit ramp. The institutions sold into the strength that was created by the performance narrative. They did it to de-risk for the long weekend. They weren't accumulating shares, they were offloading them. They sold high to buyers who were chasing the headline numbers.
And we have specific, pretty brutal examples of that fading action, the dreaded gap and crap setups, especially in the semiconductor space.
Oh, yeah. The semis, which started out so hot, they saw these sharp, really visible reversals. Western Digital, WDC, and SanDisk both opened strong, riding that memory wave, but they closed down about 1% from their morning peaks. That's money that just vanished.
And Micron, MU, which was the morning's poster child, right? It gapped up 5% early on with that incredible guidance. It also finished well off its session highs. The volatility in that complex day was almost entirely driven by profit-taking and institutional risk management.
Absolutely. The smart money just wasn't interested in holding that much exposure into the long weekend, not with the 10-year yield spiking on political friction. The trade was simple. Buy the gap, sell the spike.
Meanwhile, financials were confirming their fragility. Regions Financial, RF, dropped hard post-earnings. The guidance was genuinely disappointing. It just confirms the regional bank space is hitting that valuation wall we talked about, and it's compounded by all that credit cap regulatory uncertainty. It seems the market is worried the risk-reward there has just worsened.
This systemic weakness, even as the index is hitting records, it raises a really important question about sustainability, which brings us to the crucial metric, breadth. You had the S&P and the Dow notching fresh all-time highs today, but the plumbing underneath is getting extremely messy.
Describe this mess for us. This is what you call the two-speed market on steroids.
That's right. If you peel back the layers, the advanced decline ratio was a deeply mediocre 1.2 to 1. So even with the SPX pushing 6,958, the rally was dangerously narrow. It wasn't a rising tide lifting all ships. It was like a handful of battleships dragging a struggling fleet. The surge was driven solely by TSMC's massive 2026 CapEx guide and that applied materials breakout, which was up 5.7%.
So 2 or 3 mega caps and their key suppliers were masking weakness across the entire broader market. That points directly to the negative breadth divergence flag.
And that is the bearish alert we have to pay attention to. We hit all-time highs today, but the new high-new low list is shrinking compared to late 2025. That means fewer and fewer stocks are participating in these new highs. And here is the truly shocking kicker. Over 40% of S&P 500 components are trading below their 50-day moving averages right now.
40% below the 50-day while the index is hitting records. That just screams thinned-out rally, which historically leads to some painful mean reversion. Why is that divergence so dangerous if the headline index is still trending up?
Because it shows internal exhaustion. The market leaders are running on fumes, while the majority of stocks are already
correcting.
Or just consolidating.
Exactly.
Yeah.
And when the few names carrying the weight finally pause or reverse, which they will, especially TSM and MU after their huge run, there's no underlying strength in the other 490 components to absorb the selling pressure.
And all that exhaustion is being masked by institutional complacency, which we can see so clearly in the VIX. The volatility index is getting crushed. It's back toward that critical 12 to 12.50 handle.
Volatility is just being sucked out of the room. A low VIX implies, that Goldilocks is baked in. Institutions are aggressively selling protection. They're pricing in a perfectly benign outcome for the January 28th FOMC meeting. They're essentially saying nothing bad can happen.
But isn't cheap insurance a good thing for the market? Why do we see a VIX this low as a risk factor? Because it increases the risk of a rug pull. When volatility is priced this cheaply, any unexpected event, like the policy friction we saw today, or a sudden change in Fed rhetoric, it causes protection prices to skyrocket. And this forces systematic volatility targeting funds to de-risk instantly. That leads to a sudden, violent, and amplified sell-off. Complacency is peaking right as the rally becomes dangerously narrow. That is a toxic combination.
A highly top-heavy market, breathing thin air, as you said.
Okay.
Let's pivot to the look ahead. We've got the long weekend, so Tuesday's open is going to be a high-stakes affair. Where is the critical level we need to watch in the S&P 500?
The line in the sand for Tuesday is 6,900.
6,900. That level successfully transitioned from a ceiling to a hard floor this week.
And it must hold. If 6,900 fails on Tuesday, we immediately enter what's called a gamma void. This isn't just a simple support break. A gamma void happens when market maker positioning, based on options contracts, drops off sharply. That means there's no inherent structure or liquidity to slow the momentum down. Below 6,900, selling accelerates instantly down to 6,830, which is that October gap support. If 6,900 fails, sentiment shifts from neutral to defensive in a heartbeat, and we risk systemic deleveraging.
Understood. Above 6,900, the bulls retain control. Below it, chaos reigns. So assuming 6,900 holds the line, what's the asymmetric trade setup for Tuesday?
Well, the S&P 500 is fundamentally drawn to that 7,000 psychological magnet. It's the big round number. The reward to risk favors a long entry on any Tuesday open dip, aiming for that 7,000 target. We define the risk strictly by the Friday low of 6,938. The probability of a melt-up continuation, given the strength of the TSM and tech earnings momentum, is high. I'd put it at about 65%.
Okay, 65% melt-up probability targeting 7,000. Let's talk high-conviction day 2 plays within that bullish context. We saw 2 massive moves today that need continuation if this momentum holds.
We do. There are 2 names that offer the clearest entry points.
First up, Taiwan Semiconductor, TSM. That 4.4% jump today on the CapEx guidance was enormous, market moving.
TSM is the bellwether for the entire global AI hardware stack. Their guidance validates the industry's outlook for years. The play here is institutional day 2 continuation. We're looking for a break of the Friday high to trigger a move toward $220. This massive buy signal validates their 2026 CapEx plan, and it puts all those recent tariff bears back on their heels. TSM is a pure exposure play on the AI infrastructure boom.
And the second high conviction play, counterintuitively, has to be in the financial sector. Morgan Stanley, MS.
Exactly. Even though the overall financial sector got hit by that regulatory risk, MS surged 5.8% today. A massive profit beat, resurgence in deal-making volume. They confirmed that the deal-making supercycle is finally getting its footing. MS closed at the top of its range on heavy institutional volume. Any consolidation near Friday's close is a buy signal for new all-time highs. It stands apart from the struggling regional banks.
TSM and Morgan Stanley. 2 clear paths to continue the momentum, provided 6,900 holds the line and we don't get any systemic risk over the long weekend.
And finally, a provocative thought for you to chew on over the MLK Day holiday, tying the immediate macro context to Tuesday's open. Watch the currency context, specifically the 160 level on USD JPY. The yen has been the funding currency for global risk trades. If the yen breaks that 160 level against the dollar, the global carry trade unwind is back on the table for Tuesday's open. And that could stall this entire AI and banking momentum trade in a flash. It could force global deleveraging regardless of how the S&P opens. Stay sharp.